I think in the last 12 months, I mean, gold is up north of 60%. I mean, the only other time this happened was in the 70s when, right before Volcker raised rates. A big year for gold is 20 or 30%, and it's just been cooking with no signs of stopping. And then finally, silver has started to take off as well, which is a very good indicator that we're really getting to the heart of the bull market for these things. Bitcoin, same thing. It's kind of a substitute, and it's close to its all-time high. I mean, all-time high is 123. It's at 119 or something. So this monetary event we're going through, it could be kind of painful, and that's sad for many people. And so, the more people we can get prepared, the sooner we can get through it, the sooner we can return to sound money, the better the world will be, in my opinion.
In today's analysis, we're exploring the powerful framework of sound money investor Lawrence Lepard, who argues that the simultaneous surge in stocks, gold, and Bitcoin towards all-time highs is not a sign of economic health, but a clear signal that we are entering a crackup boom. This is the terminal phase of a fiat currency system, where capital flees the bond market in anticipation of inevitable and massive monetary debasement. Lepard contends that the bond market, while not yet broken, is critically sick, having lost over half its value since 2020. The market is correctly anticipating that political pressure will force the Federal Reserve into a deeply dovish stance, unleashing a wave of inflation that will render traditional fixed income assets worthless.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
Stock market's kind of close to making record highs. Gold is very close to its record highs. Bitcoin's close to its record highs, and the bond market hasn't fallen apart yet. So, that's the one piece that's kind of missing in the whole crackup boom. But it is sick. The bond market is sick. It appears that way, Tom. I mean, when Trump put in when we had the tariff tantrum and the market fell 15%, I thought, okay, that might be it. Maybe this whole bull market and all this stuff is over. But then, of course, he backtracked on that, and we came roaring back once again. Buy the dip worked, and I'm now beginning to think. I've often thought the stock market's overvalued and it was due for a tumble. And I'm now beginning to think, no, maybe it's going to go to just higher and higher numbers for a long period of time, based on all the money that's sloshing around out there. And so now's probably a good time to short the market, because I'm typically wrong, right? So, but when you see all these things making record highs, you have to kind of ask yourself, is this justified, or is it possible that there's a crackup boom? And I know we're going to go into the Fed, but I think a lot of this is the market maybe anticipating that sounder or easier money is coming, right? I mean, we've seen Trump, literally attack, aggressively, Jay Powell, and call for a 300 basis point drop in the Fed funds rate, which would take it down into the 1.14, 1.15 area. And, if that happens, bank lending is going to shoot up, money supply is going to shoot up, and we're going to have inflation and more money in the system. So, it's very possible that we are entering a crackup boom, is I guess the way I view it. Are we in one for sure? I don't know. It's hard to tell. Just by the nature of their moves and the aggressive, price movement on all of them. I mean, I think in the last 12 months, gold is up north of 60%. I mean, the only other time this happened was in the 70s when, right before Volcker raised rates. A big year for gold is 20 or 30%, and it's just been cooking with no signs of stopping. And then finally, silver has started to take off as well, which is a very good indicator that we're really getting to the heart of the bull market for these things. Bitcoin, same thing. It's kind of a substitute, and it's close to its all-time high. I mean, all-time high is 123. It's at 119 or something. So, and then the bonds, if you look at the bonds from 2020 to today, they've long bonds, U.S. Treasuries 20 and 30 year, they've lost over half their value. And that's just because, those bond buyers or holders are seeing that, I'm not likely to get back fair value. This bond will be repaid, but what I'm repaid with will not buy me as much stuff as, the money that I use to buy the bond with. So, when measured in bond terms, sound money assets are screaming upward and bonds are trickling downward. And so, now, the bond market has not fallen apart, which has kind of surprised me. I mean, I think they've got a lot of mechanisms to keep it under control. I mean, the fact that the 10-year is still in the mid-4s is surprising to me, but it is. And I watch that carefully. I mean, if the 10-year goes over 5, we know that's a point at which they start to have pain, because in September of 23 it did, and they had 12 people talking about how the rate cut cycle was over. and they quickly talked it back down into the mid fours. And so, my sense is that if and when they do what I'm describing with the Fed in next year, this new Fed chairman, gets very dovish, that will bring the short rates down, obviously, but the longer rates might actually do what they don't expect, which is to say they might go up. And at that point in time, I think the government will take a stance and say, okay, we've got to reinitiate QE or yield curve control to prevent the long rates from going up. It's just not something they can tolerate, Tom. I mean, with $37 trillion worth of debt, if rates go up substantially and running a big deficit to begin with, if rates go up substantially, I mean, this just gets really, really messy. And as you and I both know, they've got to roll over a lot of that debt in the short-term markets. And in fact, that's another interesting thing that Besant did, was he signaled in the latest quarterly refunding announcement for the Treasury that they're going to increase the amount of short-term bills that they sell. And the reason for that is that he's thinking to himself, okay, I'm going to increase the short-term bills because I know in May of next year we're going to have a lower short-term rate. And so at that point in time, the government will have lower interest costs on those short-term bills. I'm not going to sell these more expensive 10-year and 20-year. Now, what he's hoping is that lower short-term rates will lead to lower long-term rates. And I'm not so sure he's right. I mean, that will be the $64,000 question. What happens when they do that? How does the bond market respond? I think he's hoping that it'll respond positively. I'm guessing it won't, and that rates will go up and that they'll be forced into QE. And at that point in time, it's going to be full-on obvious that we really are in a sovereign debt crisis, and inflation is going to surge again, and it's going to get ugly. I mean, it's kind of the way I see it. This monetary event we're going through, it could be kind of painful, and that's sad for many people. And so, the more people we can get prepared, the sooner we can get through it, the sooner we can return to sound money, the better the world will be, in my opinion.
The core of Lepard's analysis lies in the price action of the true beneficiaries of this monetary event, gold and Bitcoin. He notes that gold is cooking with historic momentum, now being confirmed by the participation of silver, a classic bull market indicator. In parallel, he identifies Bitcoin as a direct substitute for gold in this role, also pressing its all-time highs. However, Lepard's key insight is explaining why gold mining stocks have failed to provide their historical leverage to the gold price. The reason is a paradigm shift. For the first time, Bitcoin exists. An entire generation of younger investors seeking high alpha exposure to monetary debasement is not buying gold stocks. They are buying Bitcoin, siphoning away a massive pool of speculative capital that historically would have ignited the mining sector.
You can see that there's some real serious demand coming in out of China and Asia. I mean, those people, they love gold and they've been seriously demanding. In the US, the ETFs have been pretty dormant. There hadn't really been much demand, and it's starting to pick up. You're seeing signs. I mean, Costco had gold bars for sale, and usually when they get them in, they sell them out pretty quickly. I mean, I think, I've had a lot more inquiries about friends. How do I buy gold and so forth? So, I would say that we're starting to see a broader interest in gold, investment managers, et cetera. So yeah, it's clearly coming, but it's not at the point where the shoeshine boy is recommending gold or gold stocks. Do you know what I mean? I mean, it's still very obscure, and there aren't, other than guys like you and me and people who listen to podcasts like this, most of the world doesn't get this, still. So we got a long way to go. So what this chart is, and I'll just describe it for people who are listening on the radio. This is a chart of the price of gold compared to the Huey Gold Stock Index, the broadest index, starting in early 2001, going to present. And what you can see, there was a bull market from 2001 to 11. And then there was the bear market, and then there's the bull market that started kind of in 2016, and we're in it still. And what you can see back in the one from 2001 to 2011 is that gold went up, but the stocks went up even more. And that's because they represent streams of gold, and gold just sits in a vault and doesn't reproduce. What you can see from the bottom in 16 to the present is that gold has gone up quite a bit. And the stocks, the response of the stocks has been quite muted. They've underperformed gold in terms of appreciation. And so there's a big kind of alligator jaw difference between the price of gold, which is at 3,400, and, the Huey, which is at, 400-ish. And so my expectation is that as people come to realize that prices are going to go much higher in the gold market, these stocks are going to catch up. And the stocks are still looking in the rearview mirror thinking, this gold price isn't going to last. But once they realize it's not only going to last, but it's going to go to 5,000, there's going to be just a very aggressive and massive move in these stocks. And so I am really, really bulled up. My fund is probably up to 70% so year to date. But honestly, from where it is right now, I sincerely believe it could double in the next 12 to 18 months. I think it will. And that's just because of the catch up. These gold and silver stocks have really lagged the underlying movement in the price of the metal. And I'll tell you one of the reasons for that, I mentioned this before, is that this used to be the only way to play alpha on monetary debasement was gold stocks. Gold would go up and the stocks would go up more. So everyone wanted to make more than just the price of gold going up. They buy gold stocks. Well, that's not really the case anymore because Bitcoin exists. So if you look at gold stock investors, they're generally over 40 or 50 years old. And so all the young people, they're not buying gold stocks. They're like, screw that shit. I'll just buy Bitcoin. I understand that argument, but it means that there's less interest in these things than there used to be. But all the same, I mean, the big pools of money. I mean, right now the entire gold stock market is about $500 billion. In the context of a stock market of closer to $50 billion or $50 trillion of value. So, it's like 1% of the total value of all the stocks outstanding. And so, what's going to happen here? I mean, these people, these algorithmic traders, these algorithmic managers and others, they're going to look at like my report and they're going to say, hang on a second, you mean to tell me the S&P went up 6% and gold stocks went up 50% in the first half of the year? Shit, why don't I have any of those? I mean, and that doesn't mean they're going to sell all the S&P and go buy gold stocks, but it means they're going to go from a 0% allocation of gold stocks to a 4% allocation. And, that 4% is not a small amount of money given how small the market for gold stocks is, if you see what I'm saying. So, I'm extremely bulled up on where this is going, in the next year or two. Now, having said that, there will come, you want to rent these stocks. You don't want to own them over full cycles because at some point in time, they will become overvalued and, the price of gold will stop going up as much. And so, there comes a time to sell them too, but we're not anywhere close to that. Like in my report, I said it's a 9-inning game. We may go extra innings, and I think we're in the 3rd inning.
This structural disruption where Bitcoin captures the capital of a new generation has created what Lepard sees as a historic anomaly and a tremendous investment opportunity. The divergence between the soaring price of gold and the muted performance of gold mining stocks has opened a massive alligator jaw valuation gap. While Bitcoin continues on its own path, he argues that large systematic pools of capital, which are still at a 0% allocation, will eventually be forced by performance metrics to chase the undervalued mining sector. Lepard stresses that we are only in the 3rd inning of this 9-inning monetary endgame. This provides investors with 2 distinct avenues: owning the pristine digital scarcity of Bitcoin and capitalizing on the explosive catch-up potential of the deeply neglected gold and silver mining stocks.